Beijing's latest data just exposed a terrifying investment freefall that's not just their headache, because lurking beneath it is a 1 billion loan bomb, and that's the beginning, because the bigger one is a trillion that's primed to explode, unleashing a property crisis so vicious it could not only drown China, but drag the entire global economy into the abyss with it. Now here's a contrarian twist, because the masses, they don't get it. And while you might just shrug off China as some distant player, they're the linchpin. A nosedive in their output could obliterate neighboring economies, skyrocket defaults, and freeze up the worldwide banking system overnight. Now, this isn't just a distant headline. It's a spark for total chaos that'll torch jobs and hurl us straight into the next financial meltdown. Plus, we just dropped a killer trade to our CTA Time Pro subscribers this weekend. Now, this optimized trade setup is riding massive waves of machine buying with a 68% win rate that crushes typical strategies. Now, hang tight to the end or snag that link in the description below and use that coupon code for your free 30-day trial and lock this trade in before it takes off. Now let's peel back the layers on this mess, starting with the raw data drop that's got economists scrambling and why this slump is a spark setting off a chain reaction of debt defaults that you can't afford to ignore. Now let's dive right into this nightmare, because China's investment freefall is primed to unleash a brutal wave of defaults, factory shutdowns, and a full-blown recession that could hit in months. Fixed asset investments shrank 1.7% in the first 10 months of the year, with estimates showing it dropped as much as 12% in October, extending a streak of declines into the 5th straight month. Now, this isn't some minor blip, because fixed asset investment is the powerhouse that fuels China's GDP. It covers everything from factories to infrastructure builds. So when it craters like this, it's a screaming red flag that the economy's teetering on a brink, with recession on skyrocketing as businesses just slam on the brakes when it comes to spending. Now, industrial production climbed 4.9% last month from a year earlier, the smallest gain in the start of this year. And sure, it sounds positive, but for China, that is disaster, because they're used to churning out industrial production at a rate about 6.5% or higher. So what you're seeing here is demand is evaporating at home and abroad, which spells massive layoffs are ahead. Now let's check out this chart of industrial slowdowns versus unemployment spikes as I pull some U.S. parallels here. Now you can clearly see the decline in industrial production shown in blue. Now you can see declines in industrial production, that's shown in blue, often match increases in the unemployment rate shown in red. And particularly notable here, it happens going into recessions, and that is the major risk here. Now this isn't just a U.S. story, because it's the same story that's brewing in China right now. And you might recall a while back I called out their record month of exports and I said it was a false dawn. Nailed it, as exports fell for the first time in 8 months, dropping 1.1% from a year earlier. And that even has Barclays economists sounding the alarm on China. If the strength in exports cannot be sustained, China's growth could face a triple whammy from the prolonged contraction in the property sector and weakened private consumption and exports. And you can see evidence of this triple whammy everywhere, because capital spending on infrastructure barely increased and growth in manufacturing outlay slowed, while property investment slid further. Retail sales, on the other hand, gained 2.9%, but check this out, slowing for the 5th straight month in the longest such streak since 2021. So what you're seeing here is this broad-based rot means those pie-in-the-high sky second-half rebound dreams, dead on arrival. Because something in October flipped the script. We're not talking just about China, we're talking about the entire global economy. And we're going to watch how their cash crunch could detonate $1 billion in loans this next week and countless others after that. And the risk here is this is going to freeze credit, and it's only going to amplify the pain. Now let's dive in, because China's declining fixed asset investment and vanishing consumer demand are about to detonate the real estate powder keg, dragging banks into a massive black hole of defaults and insolvency that could freeze global credit lines and hammer your portfolio overnight. First up, Hong Kong developer Parkview Group has a $940 million loan due on Friday with no extension in sight. There was no official word, meaning creditors are circling right now, ready to pounce. After that, we've got a fund led by private equity firm Gong Capital Partners, who already missed a payment on a $260 million facility that matured this week, leaving creditors again in a position to declare default. But these aren't isolated hits. They're the vanguard of a $140 billion foreign investor nightmare in China real estate, where distressed sales skyrocketed to $16 billion over the last 2 years alone, hitting a record 22% of all defaults. Now, on top of that, we've got hundreds of billions in prior defaults. So the issue here is this wave is accelerating as the economy spirals down. And if FAI keeps tanking, expect a tsunami of foreclosures that makes 2008 look like a mere ripple. And while banks don't want to prolong their exposure to China's property sector, selling out property in the event of default may not be appealing either. And banks worldwide are trapped in this no-win situation. Either you cling on to these toxic loans and pray for a turnaround, or you dump them at fire sale prices and book massive losses. You can see there is no solution to this problem. And with China's property values in freefall, the choice is poison either way you go. New home prices in 70 cities, excluding state-subsidized housing, dropped 0.45% from September. That's now the steepest decline in a year. And resale home values, they fell 0.66%, the fastest slide in 13 months. So property investment down a brutal 14.7% year over year for the first 10 months alone. And that extends a 4-year bloodbath that's only intensifying, as you can see. And as factories idle and layoffs mount from that pathetic 4.9% industrial output, more homeowners will dump properties to stay afloat, cratering prices further and shoving banks toward insolvency. So that $1 billion debt bomb, it's going to be peanuts compared to the trillions that are at stake here. Now, what you may not understand is, unlike Americans who invest their money in the stock market, for Chinese, they invest in real estate. So as jobs go and prices fall, it's only going to send this cratering down as everybody runs for the hills. And even this has economists ringing alarm bells left and right. Kelvin Lam, the senior China economist at Pantheon Macroeconomics, said inventory is around 1.5 years away from a reasonable level that would rebalance supply and demand. But that's assuming there's no recession. And that's an issue because it would crater demand even more. And there's a fat chance they're going to have a 1.5-year runway here if FAI continues to collapse. And Helen Kuo, Bank of America's chief Greater China economist, just broke down the investment slump post-data. She's calling it a drag on the entire $19 trillion beast, with property woes and fragile jobs keeping any rebound in chokehold. And the IMF, this is great, they blunt about the situation. China's prospects are, quote, weak, with real estate investment shrinking nonstop and the economy, quote, teetering on the edge of deflation. Well, problem is they're already there. It's only going to get worse. And let's look at another U.S. parallel of housing starts, that's shown in blue, against the unemployment rate in red. And you can very clearly see that as housing starts accelerate to the downside, at some point those workers hit the unemployment line. And next thing you know, you see the unemployment rate in red skyrocket higher. And that's the risk we're facing here, because this, again, is not just a China issue. We're facing the largest inventory overhang since the financial crisis here at home. So what that means is we're going to see the unemployment rate rise in China, here in the U.S., telling us what's happening there is one step ahead of where we're about to be. And you can start to see why this contraction in FI is a leading indicator of where China's economy is going and why it's going to lead to a massive wave of defaults, bank insolvencies, and prolonged deflation that could go on for decades. Now, China's been fighting deflation for a while. Now they have a new term for it. It's called anti-involution. As you're going to see, it only leads to more layoffs. Now, let's flip to the industrial gut punch. China's anti-involution crusade against overcapacity is backfiring spectacularly here. The nation dug up less coal last year for a third month after authorities zeroed in on unsafe and overproducing mines. Steelmaking, another commodity in the crosshairs of Beijing's anti-involution drive, saw output drop for the 5th month to its lowest since December of 2023. So here you can see Beijing's crackdown. It's going to idle workers en masse. That's going to lead to a spike in unemployment and deepening the demand dearth spiral. This is a game over situation, and Beijing has no answer. The problem is, for Chinese consumers, the pain is real and it's rising. The consumer price index rose 0.2% in October from a year earlier, that after a 0.3% decline in September, as holidays during the month boosted travel, food, and transport demand. A pickup many economists see is fleeting. And so what you're seeing here is retailers clearly took advantage of the holiday season. They knew consumers were going to pay higher prices because the situation isn't going to last. They're right, it is fleeting. And again, let's turn back to some U.S. data here to understand why. First up, let's take a look at the consumer price index shown in blue against the unemployment rate in red. And you can see very clearly there's a relationship that happens going into every recession. You see the consumer price index rising, and next thing you know, consumers falling behind. You see the unemployment rate go up as demand gets crushed. And right now, the risk is we're seeing the consumer price index accelerate to the upside, saying that exactly what's happening in China is about to happen here. But how about retail sales? Well, they are going to be fleeting. Again, let's turn to some more U.S. data here as we now look at the advanced retail sales data. That's shown in blue. It's the unemployment rate, again, still shown in red. And what you can see as the unemployment rate rises, what happens? Consumers don't have as much money. Retail sales decelerate. And again, fewer workers are needed. That, again, sends the unemployment rate even higher. And again, the risk we're facing here, right here at home, is the same story, because what is the issue? U.S. consumers falling further and further behind. Delinquency rates now for subprime at the same level they were at the financial crisis. We're seeing white-collar layoffs, all the same indicators in China that's being validated by their FIA. We're seeing it right here at home. Now you can see this perfect deflationary storm that's hitting China's economy as China has faced deflationary pressures in recent months. Record declines in prices for August and September. And again, what's happening in China is going to spread all across the world. Now, we've confronted this beast that's happened in China. And the problem is their economy is unraveling fast as investment crashes. Property bombs go off left and right. And there's a deflationary vortex that's spreading out of China. And it's going to go all over the world. But here's the path. This isn't an in-game scenario. It's your wake-up call to armor up before this fall hits home and cash in on the catastrophe. Now, you want to slash your exposure to China heavy ETFs and sectors. You want to pivot about 20 to 30% of that into value stocks, defensives, or how about this? Even treasuries, because think about this. Interest rates tend to go down during periods of deflation. Now, you want to start hoarding cash. Aim for about 20% of your portfolio being liquid. Even consider going long the US dollar here. Why? Because you want to be ready to pounce on bargains when the panic selling creates fire sales. And you want to hedge your long-term tech plays and cash in on those gains because you don't want to sleep on this. This is a countdown that could go off in a matter of months, and you would watch your wealth evaporate. Now, if you're serious about outsmarting these meltdowns, remember that killer trade we dropped to our CTA Timer Pro subscribers? Well, this optimized trade rides machine way buying. It's got a 68% win rate that crushes anything else out there. Perfect for navigating this chaos. Let's take a deeper look here, because what we're seeing, again, we put this out on Friday to our subscribers, and right now it's got a 68% win rate with a 2.5% expected return over the following 10 days. Now, how did we know this? How did we do this? Well, it's really simple. Each and every day we look at machine positioning across the broad equity, bond, currency, and commodity markets. Now, what you may not understand about the machines is they trade based on levels. What we've done is we've taken those levels, we fully optimize them so we know exactly which trigger points based on our back-tested data has the best possible outcome. And on this trade, it has a 68% win rate. Again, completely unheard of. Now, if you've never signed up, if you've never been a subscriber, here's what you get. Every day, you log in, and what do you see? Updates on our existing trades and our stop-loss levels. And then we give you the trades that I think are the best. Plus, we give you all the trades the report recommends so you can take a look at them. So what you get is the tradable signals. You get my opinion on the best trades. You get a full system that's optimized and back-tested. You get risk control levels, full tracking of all open trades or return, a weekly update. And here's the best part. You get a 30-day free trial. So whether you're brand new to trading or you're a seasoned trader using a lot of other systems, we're going to give you 30 days to compare, because when you do, you're going to see why we're changing the game with our optimized trading. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.